Good to have you with us today. Today we're going to talk about a very important topic as we move into retirement, and that's talking about Medicare, which for almost everyone will be the basis of their health care coverage as we navigate our way through retirement. Making the right choices can prove to be very important, and so today we're going to talk about Medicare choices in 2026. Starting over. What? Hold on, we're having a little technical issue here. Okay, so let's get started. Get the technical bugs out of the way. So, what's the challenge that we face as we move into retirement? Most of us will require or rely on Medicare for our health care and retirement. And the choices can be very confusing. If you're like me, every year we get that Medicare and You book from the federal government that's like 200 pages of fine print, and I don't think anybody reads it. We're going to show you today a single-page summary of Medicare that I think if you understand it, you'll be very comfortable with your Medicare choices. And making the right Medicare choices is critical because you're picking a long horse in the race. As you'll see as we go through this, the choices that we make today may limit or restrict what we can choose in the future. And so making the right choices today is very important. So what are our topics? First, we'll explain Medicare, understanding Medicare and the different options that exist. We'll talk about the 2026 changes, and we'll look at it from three different vantage points: coverage choices, cost choices, and then change that occurs based on the choices you pick. We'll discuss some tricky situations, and then finally, if we have time at the end, we'll answer your questions. So, understanding Medicare. For most people, Medicare is healthcare coverage for people 65 years of age and older. It also covers people under 65 with certain disabilities, and it covers people of any age with end-stage renal disease. Medicare is administered by the Centers for Medicare and Medicaid Services. It's augmented by private insurance companies. You'll see that there's private insurance plans that fill in some of the gaps. And the way we sign up is through Social Security. SSA.gov is a wonderful website, not only for signing up for your Social Security income benefit, but also for signing up for Medicare to get it going. So let's talk about enrolling in Medicare. You need a triggering event to sign up for Medicare. And the first triggering event is when we're turning 65. There is a 7-month window, 3 months before your birth month, your actual birth month, and then 3 months after your birth month, where you can tell the government, here's when I want Medicare to start. For most of us, it'll be the first of the month that we turn 65. If we sign up for Medicare after our 65th birthday, then it starts the first of the next month. The second triggering event applies to people that choose to stay on group health after they turn 65. There's no forced enrollment in Medicare. It's optional, and so people have a choice. They can stay on group health beyond their 65th birthday, but when you're preparing to leave group health, that's when you get a second triggering event. Within 63 days of dropping group health, you have the ability to go to SSA.gov, Social Security, and say, hey, I want to turn my Medicare on. And for most people, so that they have seamless transition from group health or private insurance into Medicare, we always recommend starting about 2 months before.
It's like enrolling in Medicare. I already did that.
You have 2 months before you turn 60. Why is that?
Because your mic was off. Say it.
Okay, well, we'll talk about to get on Medicare, you need a triggering event. And what is a triggering event? There's three windows when you can ask the government to turn on Medicare and it takes effect. The first and the most frequently used is when people are turning 65. You have a 7-month window prior to a 7-month window, 3 months prior to your birth month, and then 3 months after your birth month. That's a 7-month window where you can go into ssa.gov, Social Security website, and sign up. When you sign up, your coverage will begin on the first of your birth month or the first of the month if you sign up in the 3 months after your birth month. The first of the next month is when it starts. The second triggering event, many people carry group health and work beyond their 65th birthday. And as long as they stay under group coverage, you have a 63-day window after dropping group health to sign up. Now, for most people, you want to have a seamless transition of going from group coverage, which usually ends on the last day of a month, to the first day of the next month when you want to be on Medicare. And so we advise people 2 months prior to when they're going to lose group coverage to file a form, and we can provide the form that shows that, yes, you've been covered under group coverage beyond your 65th birthday, and now it's time that you want to enroll. And it's a form you have your HR department fill out, verifying that you've been under group coverage. We send that into a Social Security office, and they will turn on Medicare the first of the next month. And the third window is the general enrollment period. That starts January 1st of each year, ends on March 31st. So for people that didn't take advantage of turning 65 or signing up when they lost group coverage, then once every year between January 1st and March 31st, you can ask the government to turn on your Medicare. And it starts the first of the next month. Tara, why doesn't? Okay, why didn't it change? Okay, all right. Okay, so this is the form we're going to stay on today and talk most about. And if you understand this single page, you understand your Medicare choices. On the left side of the page, we have original Medicare. And at the bottom, you'll see parts A and parts B. Those come from the federal government. Part A is your hospital coverage. There's no cost for Part A for most people. It does have a $1,736 deductible per benefit period. So what does that mean? Let's say I go to the hospital and I've broken my leg and I'm in the hospital. I would pay at a minimum $1,736. If 3 months later I get pneumonia and go back to the hospital, I'd pay another $1,736. Beyond that, depending on the number of days I'm in the hospital, there can be co-pays. Next to that, we see Part B, and that's your doctor and lab coverage. And Part B does come with a monthly premium. Most people pay $202.90 each month in 2026. Now with Part B, there is a annual deductible, and it's $283. So once again, if all I have is Part A and Part B, and I go to the doctor, and the doctor says, Bill, today your bill is $283, I would pay that. After that, Part B is on a cost-sharing basis, 80-20, where 80% is paid by the government, and I would be responsible for 20%. Now, above A and B, you see another box, Medicare supplements or Medigap policies. What are these? These are programs that are available from private insurance companies, and they pay some of or all of what Part A and Part B don't pay. So there are 10 standard plans. We'll talk about those in a little more detail. Plans A through N from private insurance companies. And we'll talk about what each one of those plans covers. Most folks today sign up for a Plan G. You'll see that. And with Plan G, there are no copays. You are responsible for the $283 deductible for Medicare Part B. But if you're on a Plan G supplement and you have A and B from the government, literally after you've paid out $283 as the annual deductible, the rest of your costs are covered. So if you have a $30,000 surgery, all of it is picked up by either the government or by your insurance supplement company. Above that, you see a fourth box, and that's prescription drug coverage. And prescription drug coverage came about in 2006. That's when the plans were introduced. Up until then, Medicare only covered hospital, doctor, and lab. It didn't cover prescription drugs. But in 2006, prescription drug plans came out, and these are annual plans. What do I mean by that? Well, they start on January 1st and they end on December 31st. So they're annual. Each year we have a window near the end of the year where we can evaluate the Medicare drug coverage plans and switch if we can find a more cost-effective plan. And we'll go into a little more detail on this, but there's a wonderful government website that's very easy to use. It's medicare.gov. And the beauty of this website, you go there, you build a drug list by name, dosage, and frequency. You specify a pharmacy, and then this website ranks all of the plans available this year by their total annual cost. It also shows what their premiums are. It shows if they have a deductible, but you want to make your decision based on how much your wallet will be lighter at the end of a calendar year. So if you sign up today in May, it would take effect June 1st. On the right side of the page, we have an alternative. It's what we call a fully privatized version of Medicare. So what is a Medicare Advantage plan? These are also annual plans. They start on January 1st, they end on December 31st, and there's a window every year where you can switch between Advantage plans. And we'll talk more about it. They come in different flavors. PPO, where you can go in and out of network, where a doctor may be in network, you pay less, out of network, you pay more. There are HMOs, which are closed network. What that means is if you go to a doctor who's not in the HMO network or a hospital that's not in the HMO network, you would pay the full cost of the service. And then there's a point of sale networks version, which is kind of rare. And then finally, there are special needs plans suited for people with specific medical conditions. And you can also use that government website, medicare.gov, to identify Medicare Advantage plans and make your choice. On the right side of the page, you're seeing there's no underwriting. That is, with Medicare Advantage plans, there's no medical questions. You're guaranteed issue onto a plan each year, and you can switch back and forth. Most of the Advantage plans come with drug coverage built in. You do pay, even if you're on an Advantage plan, you do pay the Medicare B premium at $202.90. Okay, here's a chart that we're only going to spend a few seconds on. These are the 10 standard supplement plans that are available. And with most of our clients, we only talk about two plans, Plan G and Plan N. So why do we talk about Plan G? Because it's very comprehensive. The only thing Plan G doesn't cover is the Medicare B annual deductible. So yes, you're responsible for $283, but beyond that, you see that there's almost complete coverage on Plan G. For people that are operating on a more limited budget, Plan N may be a good option. What is Plan N? Well, with Plan N, you have a $50 copay if you go to an emergency room. You have a $20 copay at the doctor or the specialist's office, and you also are responsible for the excess charge. And I'll touch on this very quickly. Medicare doctors have to accept the assignment rates that the government has established for every medical procedure that's provided. Assignment rates. So what is that? If I have my blood pressure checked, the doctor gets paid a certain amount of money. Well, most doctors accept the assignment rates, but Medicare doctors are allowed to charge a 15% excess charge. Very rare, but some do. And if they do charge an excess charge, then it's not covered under a Plan N. whereas under a Plan G, it is fully covered. Those are the two most effective plans. Plan G for the people that can afford it, and Plan N for those that are on a more limited budget. So let's talk about the drug plans. The drug plans have an open enrollment period from October 15th to December 7th each year. So we advise all of our clients to go back to Medicare.gov each year and check in and see if they are still on the most cost-effective plan for the next year. I've had many clients call up and go, Bill, I'm happy with my drug plan. I like it. Why should I spend time going to Medicare.gov? And the reason is by rerunning your drug list for the coming year, picking a pharmacy, you can save hundreds, sometimes thousands of dollars because the plans change subtly. The comp plan providers move products, drugs from, say, preferred brand to non-preferred brand, or from preferred generic to non-preferred generic. And so it's important to go to Medicare.gov every year from October 15th to December 7th and rerun your drug list and make a smart choice to save yourself money. In 2026, there are 12 plans available in the state of Texas. There's two phases of coverage. There's a deductible phase where you might be responsible for the first $615 of cost. And then there's the initial coverage phase where you're responsible for 25% of the cost of the drug up to $8,000. Here's the good news about what's happened to drug plans over the last 3 or 4 years. If you go back 4 years ago, there was no maximum out of pocket for drug costs in a calendar year. Well, 2 years ago, they reduced the maximum to $8,000, still a sizable amount of money, but they limited it to $8,000. Last year, they reduced it to $2,000. So for people that are on very expensive drugs, like cancer drugs, where it might be $8,000 or $9,000 in a calendar month, they hit that maximum the first week or two of January. This year, the maximum out of pocket for drugs is $2,100. So it's kind of nice. We've moved from a point where there was no limit to now where there is a limit. Also, during the Biden administration, they passed legislation that for the first time allows Medicare to negotiate with the drug companies. They picked 10 very expensive drugs. You may see some of your drugs on this list. Well, the beauty of it is in 2026, the government gave Medicare the power to negotiate down these prices. We live in a country with private health insurance, and that's sponsored, with Medicare as the base, but then with private insurance around it. If you lived in Canada, France, Germany, they all have nationalized health care. And so for years, those countries have negotiated and been able to offer their residents much lower drug prices. Well, now finally, these 10 drugs are on the list that Medicare has reduced the price because they've given Medicare the authority to negotiate. Let's talk a little bit about Medicare Advantage plans. And I will tell you something up front. We call them Medicare Disadvantage plans. Not picking on them, but over the years, we've talked to many people. In fact, in the early years, these plans came out in 2006 also with the drug plans. And for the first 2 or 3 years, we offered Advantage plans to clients, and we explained the difference, compared them, and people made their choice. But around 2009, Tara and Stacy and I decided we aren't going to offer Advantage plans anymore. And the reason wasn't that they're bad. The reason was our clients that were on them continued to issue complaints, problems with being able to go to a specific provider, a doctor or specialist or a hospital. Sometimes they were restricted, and also hidden costs. And so back in 2009 or 10, we decided, since this isn't what I would choose, I'm on a Medicare supplement with parts A and B from the government, and I have a drug plan. If I wouldn't buy an Advantage plan myself, why would I recommend it? But they are available. So let's talk about them. The open enrollment period every year to switch plans is October 15th to December 7th. During that window, with no medical underwriting, you can go in and say, hey, I want to change from a plan with Aetna or Blue Cross to a plan with Cigna or United Healthcare. You can change between plans. And as I mentioned, these plans come in 4 flavors: PPO, in and out of network; HMO, have to be in network; POS, point of sale, which means doctors can literally opt in and out on a weekly basis, which is kind of confusing. And then there are special needs plans for people with specific medical conditions. So there's four different types of plans you can choose from. The key question, if you want to consider an Advantage plan, is go to each of your current doctors. Go to the hospital you might use. Go to the nursing home you might eventually need rehabilitation in, and ask, what do you accept? Because just because a doctor accepts an Advantage plan from, say, Blue Cross, doesn't mean that he or she accepts one from Aetna or Cigna or someone else. Well, let's compare the supplements and the drug plans with Advantage plans. With a supplement and a drug plan, you can go to providers anywhere in the United States. So if you travel a lot, sometimes having the freedom of going to a doctor outside your home area can be very beneficial. You know that you maintain coverage wherever you go in the country. Added benefits are available with some of the supplements. Drug plan is always a separate option, and there's no referral to go to a specialist. I have glaucoma, so I go to the Glaucoma Institute. I don't have to be referred. I can just go there. What about Advantage plans? Well, they're more network oriented. There's regional networks, and then there's national networks. So you always want to make sure that the doctors you want to go to are in network, so you pay less for your cost of care. There are added benefits that are advertised for Advantage plans, maybe a vision discount or a dental discount. Different kinds of discounts. You'll hear these advertised usually between October 15th and December 7th. Most Advantage plans include a drug plan integrated, and many of them require a referral to a specialist. So something to keep in mind as you compare plans. What about cost? Well, this is an example. These numbers are not hard and fast, but let's say you're on a Plan G supplement, and let's say it's $140 a month. Your out of pocket for the calendar year is that Medicare B annual deductible, $283. So what is really this saying? This is saying that if you're on a supplement and on original Medicare, your costs are front loaded. You're paying a premium for Plan G, but you may not go to the doctor very often. When you do start going to the doctor, that's when it kicks in. You're paying a premium for Part B, but you're limited in what your exposure is if you need major surgery. The drug plans, the premiums can range this year anywhere from $0 up to $167.40 a month. And with drug plans, there are always co-pays. What about on the Advantage side? Well, cost-wise, there are 32 plans in Travis County as an example, and the premiums range from $0 all the way up to $142 a month. With Advantage plans, there's an out-of-pocket maximum, and those 32 plans range from $3,800 out of pocket up to $13,900. Now, below that, I say cost is backloaded. What do I mean by that? If you're healthy and on an Advantage plan, paying no premium can sound very, very attractive. Once again, I like saving money too. But it's when you start exercising the Advantage plan that you may start to encounter some of these out-of-pocket maximums. So it's something to think about. If you're going to consider an Advantage plan, I would ask the plan provider, where is my cost exposure? If I need surgery, how much might I be out of pocket? If I need an MRI or a CAT scan, how much might I be out? Ask those plans so you don't get blindsided. As we mentioned earlier, drug plans are usually included in plans, and they have co-pays. Finally, let's talk about change. This is an important aspect of making any decision that will affect a long-term retirement. On the left side, supplements and Medicare have been around for 50 plus years. The supplements don't change. In other words, a Plan G 10 years ago offered the same benefits as a Plan G today. The premiums do increase as you age. So if you're going to get a supplement, you have to factor that into your budget. You have to factor in a certain amount as the premiums increase as you age. And drug plans, as we mentioned, change annually. So it's very important to go back to Medicare.gov. I had a lady several years ago. She called up and said, I got the newsletter. I'm supposed to go to this Medicare.gov and compare drug plans, but I like my plan. And I said, ma'am, I like my plan too, but I like my wallet even more. And so I said, here's how you go to Medicare.gov and compare plans. Well, she got to the last page and it did compare the plans, but she got confused because it shows premiums, deductibles, other numbers for each of the plans. Well, I talked to her and I said, ma'am, look at the middle number that it's showing you for each plan. That's your total annual cost. That's how you make your decision. If you scroll down, you'll notice that the annual cost gets bigger, more, you have to spend more. So I said, is the winning plan on your screen the one you like, the one you're on? And she said, no. And I asked her, I said, what's the annual cost for this plan? Once again, this is 3 or 4 years ago. She said, $1,600. I said, okay, scroll down and find the plan you're on, the one you like so much. And she did. She said, I found my plan. Then the phone got very quiet. Finally, I said, ma'am, are you still there? And she said, yes. I said, well, what's the annual cost for the plan you like? She said, $3,500. And I said, well, ma'am, if you switch now during this open enrollment period, you're going to save $1,900 next year. And she was a happy camper. So we advise everybody should go back and check annually. The Advantage plans have been around since 2006. They do change annually. The premiums change annually. And many plans are changing dramatically in 2026. Why is that? Well, if you remember, the government passed a bill called the Big Beautiful Bill last year in 2025. That bill reduced compensation to the Advantage companies. It reduced it 4%. It may not sound like much, but United Healthcare, a major provider, pulled out of 160 markets in the United States this year. I'm worried that as government budget deficits continue to soar and the government looks for ways to save money, they may cut additional compensation to Advantage plans. Just a question, not a statement of fact. But if they do, I think you may find that Advantage plans providers may be pulling out of the market. So we talked about cost, coverage, and change. 3 ways to size up supplements and drug plans and original Medicare with Advantage plans. And, this is a lot to cover in a few minutes. We answer questions free. Just call us up and I'm happy to answer any specific questions that you have regarding Medicare supplements and Advantage plans. So let's talk a little bit about telehealth and Medicare in 2026. Telehealth is becoming very popular, where you can talk to and interact with a doctor over the telephone or over your computer. And for 2026, they've extended telehealth benefits through the end of 2027. They may well extend them again. Video and audio only calls are covered when appropriate, also through 2027. Behavioral health, telehealth benefits are now permanent, which is important because part of medical care is behavioral health. The Part B cost sharing, same as in person after the $283 deductible and 20% copay. Medicare Advantage plans may offer additional telehealth benefits and at $0. Have to compare, ask about what your Advantage plan covers. And then Medicare supplement plans cover 100% after you've hit that $283 deductible. So what services are covered? Primary care, office visits and follow-ups. Mental and behavioral health is now permanent. Chronic disease management, things like diabetes, heart disease, hypertension, those are built in. Specialist consultations, nutrition counseling, preventative screenings and annual wellness visits, and finally, prescription management. The DEA prescribing of controlled substances via telehealth has been extended through December of 2026. Texas Medicare Savings Plan. This applies to people that are on very low income. In 2026, there are some additional benefits available. One is the QMB, Qualified Medicare Beneficiary. This covers Part A and Part B premiums and cost sharing, deductibles, and co-payments. So if you're on a very limited income, you can apply for QMB. This is one of the Medicaid plans that we know of. We don't practice heavily in it, but we can advise on what it takes to sign up for QMB. There's also the Specified Low-Income Medicare Beneficiary, SLMB, covers Part B premiums. Limits are $1,500 monthly for singles and $2,135 per month for marrieds. There's the Qualified Individual QI, covers Part B premiums. These are different programs that are available. If you have a question, dialing 211, you can ask to be tested income and asset-wise for whether you're eligible for one of these programs. An application is through Texas Health and Human Services. So if you do call 211, they will send you forms. You fill those out, send them back in, and then they'll tell you, hey, you're eligible for QMB. And so maybe that reduces or eliminates your Medicare B premiums. Let's talk about employer choices. This is a very important topic and also very confusing. If you work for a company that has less than 20 employees, then it's important to sign up for Medicare Parts A and B because Medicare is primary. Companies with 20 or fewer employees, Medicare is primary. Let's say you work for a company like that and don't sign up for Medicare, then you have a major medical expense, some expensive surgery. Well, your insurance carrier could well say, well, we'll pay as soon as Medicare pays. But since you didn't sign up for Medicare A and B, they don't pay. So less than 20 employees, always a good idea to sign up for Medicare Parts A and B. If you're 20 plus employees, then the group plan is primary, not Medicare. And so you could sign up for Medicare Part A, it's free, but we would advise I wouldn't sign up for Part B because your group plan is going to pay and you'll be paying a premium for Part B and never really getting any benefit. So if you're staying on group health beyond your 65th birthday and your employer has more than 20 employees, you can delay signing up for A and B and then sign up when you're about to drop group coverage. So if you are going to drop group coverage, you want to sign up for Medicare Parts A and B, select a Medicare supplement plan, select a prescription drug plan, or sign up for Parts A and B and then sign up for a Medicare Advantage plan. Tricky situations. There's 4 of these. Health savings accounts, HSAs, COBRA, high income surcharges, IRMA. It's not a lady, that's a surcharge. And then what happens if you have a spouse younger than 65? So HSAs have become popular. This is where people can contribute pre-tax money into an account and use it for medical expenses. Well, you can't be on any form of Medicare, either Part A or Part B, and make pre-tax contributions to an HSA. If you do, there will be a tax penalty. And where it gets tricky, if you sign up for Social Security benefits after age 65, they automatically trigger the start date for your Part A 6 months prior. Well, if you've been making contributions to an HSA, there will be a tax penalty. So the simple answer on HSAs, if your organization has you on an HSA and you know you're going to retire 6 months in the future, stop making pre-tax contributions as well as your employer to your HSA account. What about COBRA? Dropping COBRA is not a triggering event, as is dropping group health coverage. So what is COBRA? COBRA is extension of healthcare benefits under a group plan after you've retired. You can do this. You can elect COBRA before or after age 65. Let's say you retire at age 64. You could, if you wanted to, elect COBRA, and it would cover you through your birth month turning 65. But dropping COBRA or COBRA ending is not a triggering event. COBRA either lasts 9 months if you're in a small company, or generally 18 months, up to 18 months if you're in an employer that has more than 20 employees. So let's say I'm 66 and I'm getting ready to retire, and I go, hey, I don't want to worry about Medicare. I'll just sign up for my group plan under COBRA and continue it until it runs out, and then I'll grab Medicare. Well, let's say the COBRA doesn't end at the end of the year. Let's say it ends June 30th of this year. Well, COBRA ending is not a triggering event. So I can't tell the government, hey, I want to turn my Medicare A and B on and get a supplement. I now have to wait 6 months until January 1 when I hit that open enrollment period. So the simple rule on COBRA, use it before age 65, it's fine. But after age 65, it's not fine. You want to stay away from it, because when it ends, you don't have the ability to turn on Medicare A and B, get a supplement or Advantage plan. There's a lapse in coverage. And that can lead to possible late enrollment penalties for parts B and D. You know, the government has a stick and carrot approach. They want everybody on Medicare Part B that isn't covered under a group health plan, and Part D if it isn't covered under a group health plan. So the government, if you don't enroll in Part B, let's say you turn 65 and you don't enroll in anything and you're not working covered by group health, when you enroll 3 years later, there will be a late enrollment penalty. You'll pay a higher Part B and Part D premium the rest of your life. That's painful. We don't want to do that. What about IRMA? Well, IRMA's not a sweet old lady. IRMA is the income-related monthly adjustment amount that you have to pay for 3 parts of Medicare, Parts B, Part C, and Part D, if your income is above a certain level. So these are the 3 parts. I've got them blocked out in yellow. Part B's premiums can be higher, your drug plan premiums can be higher, and your Medicare Advantage plans can be higher. So here are the income thresholds for individuals and couples in 2026. If your income is up to $109,000 and you're single, you don't pay any IRMA surcharge. You're paying the $202 for Part B, and there's no add-on surcharge for Part D for drug plans. But if your adjusted gross income puts you a few dollars above that $109,000 threshold, let's say $110,000, then for the entire year, you're paying $284.10 if you're single, or if you're $284 for Part B, and you have a surcharge of $14.50 that's added on every month. If your adjusted gross income is $1 above that 109 or the 218 limit, you pay the IRMA surcharges. And you can see the higher tiers where if your income is much higher, you can pay a substantially higher Part B premium and Part D surcharge. Here's the good news. You don't have to pay these. Let's say, and by the way, they base your IRMA on your income 2 years prior. So in 2026, they're looking at your modified adjusted gross income in 2024. Let's say you were working in 2024 and 25, but you retired the first of 2026. Well, there's a form we can send in to the Social Security Administration because they're going to default back to that higher income that they find from the IRS records. And you can report and say, hey, I retired. I'm now earning much less. And they will immediately adjust your IRMA surcharge down to what your appropriate amount should be this year. So just, you're not locked in for 2 years paying the higher surcharges. So how do we avoid Medicare IRMA in 2026? It's based on your 2024 income. The form that reports a life-changing event could be that you retired or reduced the amount of work, could be divorce, could have been death. Use form SSA 44 to report lower current income. You can also, one of the options we help clients with is investigating tax deferred products. Let's say you've got a bunch of money in a CD that's earning interest that puts you above that IRMA threshold. Well, just by repositioning some of those funds in a tax deferred product, you still earn the interest. You just don't have to report it on your tax return, and therefore you don't pay the higher IRMA surcharges. If you have a Roth account, you can begin withdrawing funds from a Roth account, and because Roth accounts, whatever you put in was after-tax money, and whatever it's grown into is tax-free, so it doesn't affect your bottom line adjusted gross income. You might choose to delay Social Security. Last week we had a webinar you can go back and listen to on Social Security benefits and how to maximize your lifetime payout. Well, one of the ways is by delaying Social Security. So let's say you decide not to take Social Security at your full retirement age, which is, let's say, 67, and you wait till age 70. When you start at age 70, you start 24% higher, 8% for each of the 3 years you didn't take benefits. Well, gee, Bill, I'm giving up a lot of money if I delay Social Security. Well, not only do you save on your IRMA surcharges, but when you start claiming Social Security, you're starting with a higher amount. And there's a chart in a book that we wrote. Tara and I wrote a book, More Money for Retirement, and it shows that the claiming payouts, the lifetime payouts, cross at age 78. So what do I mean by that? You can claim Social as early as 62, as at your full retirement age 67, or as late as age 70. When you start at age 62, you start at 70% of what you would get at full retirement age. By delaying to age 70, you start at 24% higher. Well, those three lines of total cumulative lifetime payout cross at age 70. So I ask people, do you think you're going to live past 78? Well, yeah, I think I'll live to 80 or 90. You're money ahead by delaying Social Security. Not only do you not pay IRMA, but you also earn more income over your lifetime. And the last option, qualified charitable distributions. We have a webinar coming up in the future on how to pay less tax. One of the ways is once we turn 73, we're forced to take required minimum distributions out of our IRAs or 401ks. Sometimes that income can put you into an IRMA category where you're paying higher IRMA amounts. Maybe you also have a bent for charitable donations. Well, today you can do what's called a qualified charitable distribution. You're going to have to take the RMD anyway if you're 73 or older. Well, why not take it and have it sent directly to a qualifying charity? That income doesn't count against the IRMA surcharge. So there's a variety of ways to stay away from IRMA. Finally, let's talk about a spouse younger than 65. Let's say you're 65, but your spouse is 63. And you decide, hey, I think I want to get on, and I'm working, and I'm have my spouse on my employer plan. Well, if I drop off of the group plan, my spouse has some choices. They need to get to age 65 also to get to Medicare. So here are their options. If my employer has less than 20 employees, they can request 9 months of state continuation. It's kind of like a mini version of COBRA for 9 months. But if my spouse is 63, that won't get her through to age 65. With employers that have more than 20 employees, COBRA either runs for 18 or 36 months. So if my spouse is, let's say, 2 years younger than 65, is 63, the 18 months, once again, won't get us home. So in that case, we'd have to consider the Affordable Care Act, ACA, or some other form of individual health insurance so that we maintain health coverage. Very important as we move through life and into retirement to maintain coverage for medical expenses. You can spend 1 week in the hospital today and easily run up a bill of $200,000 or $300,000 or $400,000. Medical care is incredibly expensive, so we always need to be maintained coverage. And Medicare is a phenomenal way to do that. We covered a lot today. Down at the bottom of the screen, you'll see Our email addresses, you can always email us. It's bill@srctexas.com, Tara@srctexas.com, or Stacy@srctexas.com, or just give us a call, 512-835-0963. Call us. Our phone calls, our meetings, consultations are always free. So we welcome your calls and happy to answer any questions you've got to make sure that you know what you're doing for Medicare when it's time to make your choices. Thank you for joining us today. Join us next week for another exciting topic relevant to creating a safe, secure retirement. Thank you.